But I really want to thank you and thank Bob for the idea of putting this together. 15 years ago at Duke, Bob was involved again, and it was 20 years after the Black-Scholes model, and Fisher Black and Myron and myself were there. Sadly, Fisher is not here today in body, but he certainly is here, and his work is as relevant today as ever. And as we heard this morning and this afternoon, we see exemplified that it's not the formula that has lasted all of these years. That's a very special case. It was important because then people could look at it. But as everyone said today, their models aren't that model, constant vol, constant interest rates, and so forth. But what we've seen is that the sort of dynamic portfolio construction, either to do systematic hedging or actually dynamic replication, was really the kind of robust methodology that has sustained itself. And we've seen in every piece today here. And I think that's important to measure, to mention in an event like this, because we have been able to sustain stochastic volatility, jumps, Levy processes, fat tails, thin tails, every kind of tails, multi-whatevers, multi-factor risk premia, as we heard, and even non-traded securities, and it still applies. And that's what I think has given it legs, and that's why it's still interesting today. Now, the topic is financial innovation, and that's a dear one to my heart. It's kind of hard to be standing up here in the middle of this crisis and pretend it isn't here. So I think I really need to say something about that, and I will. And then I hope to say something after that about financial innovation into the future and some of the challenges and opportunities. Now, on the crisis, let me say, if you think of a metaphor for what, can you imagine someone is brought into the ER room, that's the emergency room. What's the first thing that the doctors in that room have to do? They got to get him stabilized or her stabilized. They don't even know what's wrong. They're not going to try to fix them. They're just going to try to keep them stabilized, because if they didn't, and they go on to the hereafter, the rest doesn't matter. But then after they get him stabilized, what's the next effect? They say, well, gee, he's got a broken leg. I think we probably ought to set it. And a few things like that. So they actually tried to decide about solving the problem. That's kind of intermediate. Why I say intermediate is, if you don't think longer term, you may set the leg so it will come back, but if you set it wrong, that person will have pain and dysfunction perhaps for the rest of their life. So even though you've normally solved the problem, if you don't solve it, you can solve it different ways, for the short term or the intermediate term or for the long term. My metaphor, that's my metaphor for thinking about how to deal with crises. Now, it takes different personalities in that story I told. The ER room MD is not an engineer. He or she is an intuitive person, looks at the thing and says, what do I got to do? Boom. And makes a very, very, sort of snap, total decision, which is what they have to do. They have to look at the whole thing and come up with a solution. Those of you, or many of you out here are engineers, know that's the antithesis of every engineer. You want a system, break it down, you want to do it right, you want to test it, you want to do all that sort of thing. Imagine if you had that kind of personality in the ER room. You wouldn't have anybody surviving. That said, though, if you take that ER doctor who does things intuitively and jumps to the solution without going through all the steps, that may not be the best person to design a bridge or to design the financial system structurally. So what I want to point out is that it's very few people who can do everything from the ER room immediately through the engineering of the solution. And I will confess that if I can do anything, I'm an engineer, not an ER room. Now, I have the good fortune of going first in the panel. The two gentlemen over there are one of the few who are both capable of doing the ER room solution because they're engaged in the markets. They don't have a choice but to make quick overall decisions in real time. But they also have the engineering, as you can see from their background. So I'll leave for them to do what I certainly can't do. Now, before I leave to talk about the natures of crises, I want to make 2 points. One, Bob Schiller made this morning, but I want to emphasize it. There are real losses here. He said 5 trillion. I've been saying 4 trillion loss in residential real estate, and people were sending me missives saying you got the wrong digit, you're way too high. But Bob said 5, so it's another trillion since I spoke, and Warren Buffett said 4, but in any case, it's a very big number, okay? And those losses have to be absorbed. They're not going away. They're not coming back. And we have to recognize that in any solution. It isn't all about a liquidity crunch or a credit crunch in the narrow sense that when we unwind it, everything will be back. And we know we've lost about $9 trillion in the equity market, so that's about 85% of GDP. So these are very big numbers, and that's important to keep in mind in thinking about the crisis. The other is, what is a derivative? Now, they asked this group. If you look at the way it's described in the press and by congressmen, virtually anything that's a problem is a derivative. Now, I don't mind, for example, think of a structure. You have assets on the left side, your point of view, okay? And then you have, senior debt, junior debt, and equity is a simple, basic kind of structure. They're calling those three things on the right side derivatives. Well, I would too, because that's the way I think of it, and I think that's the way others do. But if you believe that, then every corporation, every right side balance sheet is a derivative. And then you think about ordinary mortgages. We know they're derivatives. They have both an option for credit and they have an option for repayment. And we know every guarantee is nothing but a derivative. And in fact, as you extend it a little bit more, everything's a derivative. Now, when I say derivatives were the cause, and if everything is a derivative, you realize that doesn't have a lot of content in it. Okay? So I'm making a little fun of this, but I'm saying that somewhere, somewhere this has to be straightened out, because there really is a lot of crazy information. But that said, let me now address some of these issues about crises that I wanted to bring up. First, this is a little bit, I can't do it the way he would have, so I'm not going to try, but just to locate it. Remember Fisher's fact and fantasy about options paper? Well, I'm not going to reproduce that, but think of this in that spirit. So I'm just going to name some things that are brought up. Crises. How many times have we heard people say, we keep having these crises, we keep making the same mistakes over and over again. It's like we never learn anything, and all we have to do, a little passage of time, it's all gone. Leverage, or something like that, right? We're always getting too much leverage. We never have enough transparency, all right? And there's all that. Now, I'll tell you a little story. There are some ladies in the audience, so forgive me. I know you don't wear ties, but you may have bought them for someone. But those of us know that tie styles change. So you have a wide tie, and then they change, they get narrow, then they get wide again. By the way, I tell you, narrow ones are coming. For those, they really are. But in any way, so I got smart last time, and I said, you know what? I took my wide ties when they went narrow, and I took each one of them, I very carefully pressed it and put it in my drawer. I said, I'll wait. And I waited. And eventually the white ties came back, and I said, aha, I pulled it out of the drawer, put it on. Guess what? It's true that they were wider, but not the same width as mine. Everybody knew it was a 1972 wide tie. Now, the point for the story is, at high enough, 50,000 feet, if that's your metaphor, yes, you look like you're repeating. But I believe what happens is that every time you get into more detail, the nature of the crisis is different, and it's enough different so we're not comfortable. We heard talks of surviving. Well, of course, non-survivors don't give talks. So you understand that that's almost a sure thing, in any conference. But what I'm saying to you is that we need to recognize that the nature of crisis, in part, is that we don't understand everything. It isn't just a large move. There are elements that we're not familiar with. And as somebody who lived through the 1970s, which I'll come back to, that looked pretty bad. In some ways, you could argue it looked to me worse than today, knock on wood, because the fates have a way of teaching me, you think it's bad, let us show you. But what I'm saying is we survived the 1970s, so it couldn't have been that bad. So the first point is that things are simple repetitions. I don't think that. The second one comes up is, have we made any progress in finance at all? Many would say we've actually gone downhill. It's been negative. But we haven't made any progress. And I'd like to point out that there are a whole bunch of things. relative, let's say, even to 10 years ago. By the way, if I was giving this talk last year, I would have said 9 years ago. There's a fixed point in my life, well, in our lives, but I won't speak for my colleagues, okay? There are a couple of fixed points we have, but anyway, but that one. But you know, that if I look at that and I say, people say to me, have we made any improvements to then? And I would say, here's my list of the improvements. First, I think there's no question we can measure and manage risk much better today than 10 years ago. Okay? Secondly, I think central banks, in general, much better understand all the financial markets than they did 10 years ago. I don't mean they're experts on it, but in terms of their familiarity and understanding beyond knowing the ISLM curve is very substantial. They understand interest rate models to some degree and so forth. What's the third one? Two-way mark-to-market collateral for over-the-counter derivatives. That's a big deal. Okay, it doesn't mean we're away, but in terms of that. What else do we have? Now, what's been one of the biggest complaints? Lack of transparency, right? Everybody says nothing's transparent. I don't think that's really true, even in the credit world. And what I have in mind there is, think of CDS. That's a big market. It's a professional market. And we have prices every day. You don't have to like them. Compare that to the last bank crisis, when all you had is opaque loan portfolios that were never marked. You had no idea what credit was. You couldn't look at subordinated loans. So the very fact that even we can look at those today is a big deal in terms of information. We heard all about the VIX today. It's a whole new asset class. And the amount of information that you can get from implieds is huge. Well, that existed at some level, nothing like it does today, and that you can trade it. I mean, I'm just thinking of GE. I'm giving it away. I should have said what several Fridays ago, before we were in bad things, but there were a lot of stocks whose implied vols had gone out. But GE was one, I think it was at 151 vol points. Now, that's like 7 times whatever it had been. Now, what was the information in that? You say, well, there's something here. You know, the stock was down, but so did a lot of other stocks. What was the market saying there? And, okay, and you say, they're talking about GE Capital. I mean, anyone's been to the market. I don't want to get off on it, we'll be done. But you see my point. There's a lot of information in the market. You can no longer get away as a rater, as a credit, as a rating institution, just putting on ratings and let them stick there because you've got these darn prices there every day. And as you know, the corporate bond market is one of the most on illiquid ones. So I would say these are all good things, and global investing. So why aren't we all safe today? What happened? It's because other things have changed in 10 years. We've become much more complex. In general, we've reduced the amount of capital, increased the amount of leverage, which makes sense. If you can manage risk better and distribute it better, then you don't need as much cushion. That's efficiency. But it does have that feature. You also have coupling across markets, as everybody knows, which is a feature of global investing and the movements across markets. So you have that as a negative. And the only lesson I want to point from this is to say that when people ask, are you safer, that's not the right question, because almost always when we get something that could make us safer, a lot of the benefit we choose not to make ourselves safer, but to do things that were too risky before but are appropriate with the better rules. So we drive faster in a four-wheel drive car than we do in a two in bad weather, rather than drive the way we did with our two-wheel drive car. And that's something to keep in mind in evaluating where we are. And that's it. Now, third point, I actually thought I should get to something on financial innovation. The relation between financial innovation and crisis, right? People have said, that damn financial innovation has caused the crisis. Is there a relation? I would say there is a structural one. And the structural one is the following. For successful innovation, it's always going to be that the infrastructure to support that successful innovation will be inadequate for a period of time, maybe a considerable period of time. How can I say that with such a surety? Because if you have 100 innovations, and out of 100, 2 are successful, it is impossible, it is not practical to build an infrastructure to support all 100 in advance. You'd never do anything. So what you do instead is to find the successful ones, but then you're going to be behind the curve. When I use infrastructure, I mean regulatory oversight, the market capability. I believe that's structural in the sense I don't think you can get rid of it. It's a trade-off. And like the high-speed train, you know, one that can go 200 miles an hour, which I'd love to have between Boston and New York, but the problem with that is they could build the train, they have the train, the tracks won't support it, the infrastructure. Now, no one's going to drive, I hope, 200 miles an hour on the tracks that exist now. So when you have this mismatch, you do need regulatory or other oversight to balance it. But it's important. So I think that's structural. Now, what's behavioral, I believe, not real, but real because it's behavioral, is that something we're familiar with, we view as having much less risk than something's new. And by definition, innovation is new. What I have in mind, I don't have time because I'm losing what I have, as a case example, take after Enron, some of you, I'm sure, were called up and said, by boards or something, will you come in and tell us whether we've been Enronized? You know, do we have derivatives or SPVs sneaking around in the company? So you go in and you say, you look and you look and you say, nope, you have none of those. But you do have a defined benefit pension plan, an ERISA plan. Well, doesn't everybody? Well, you know, we know they don't anymore, but they used to. And then there's still a lot of it out there. Now, let me just quickly show you what I'm talking about. I think everyone would agree, not that I'm recommending this as a policy, that if you have a defined benefit plan and you have fixed money, fixed obligations, and if you hold as assets, match funding, both risk and everything else to it, so you immunize it. Since that's the collateral first clause, that's basically off your books economically. Now, I'm not saying you want to do that. I'm saying that's the case. Therefore, the decision to put 75% of the portfolio in stocks incrementally adds risk of the following sort. You're basically buying, in the case of General Motors, just so I can use dollars, $75 billion of equities, financed 100% by $75 billion of long-term debt, fixed-rate debt. What is that? That's exactly equivalent to going long a $75 billion total return swap where you get paid the stock market and pay fixed. Now, could you imagine Rick Wagner getting up in front of you as the stakeholders of General Motors and announcing, I've decided this year to take a position of a $75 billion total return swap paying fixed where I received the stock market? I think the directors would say, excuse us, we're having a break here now. And the next thing is that they'd say, he's gone off to, you know, to get some rest. But if you work it through right down to the accounting even, the total return swap I gave you and that pension position are identical. And to put it in scale for you, at the time they actually had this position, the market cap of GM was $11 billion. Now we know where it is. Oh, I'm sorry. Got to quit. All right. So all I wanted to say to you is that that's the last feature. I'm going to skip just a few quick, fast things. Contagion. I only point out to you that if you had perfect risk sharing, we'd reach nirvana. What would be true about everybody's holdings in this simple model? They'd be perfectly correlated, wouldn't they? So what looks like contagion could also be evidence of much better risk sharing. I won't go any further, just point that out. That's quite different interpretation. What about getting rid of mark-to-market accounting? Does that improve transparency? And this is not an abstract question. Okay, what about incomplete descriptions, which of every models are a reality? That create biases for rating agencies. Nonlinear risks is one of the things that I was referred to this morning. Every derivatives book person knows of nonlinear risk that goes up. I would submit to you, if you want to understand at least a portion of what's going on in the macro financial risks, it's understanding that risk propagation across the sectors, government, corporate, household, banking, there are a lot of guarantees. Every credit contract is a nonlinear derivative. Every guarantee is a nonlinear derivative. What do we know about that? When the assets go the wrong way, the delta changes to being much, much more risk. So if you never change the position, your risk goes up dramatically. We heard from Tom Ho about, what did we hear about? Compound options, options on options. The government's guarantees of the banks are options on options. That's very convex. So not to say anymore because I've run out of time, but I would say that it's kind of interesting to look at that this idea that we have 10 sigma events, it may not be 10 sigma. It's just we're using the wrong delta. We're applying much too low a delta, and therefore the appearance of the sigma is much larger. So I would leave it on that. As to the future, with all the bashing of finance, science, engineering, derivatives, I want to say I'm optimistic about innovation, provided we can control the regulatory process to be done, not to have no regulation, but to be done by engineering types rather than MDs, in my opening remarks. If we can do that, remember the 1970s, Bretton Woods, the first oil shock, 50% real term decline in the stock market, double-digit inflation, double-digit interest rates, all new things to us. It spawned the highest degree of innovation to deal with need, because need is the biggest driver, in my view, of innovation. And so we could come out of this, as long as we don't massacre it with the wrong regulations, and we survive to get there, the R room, we could come out with a lot more innovation. And I think I will just, I had some other things on breadth. Oh, I want to say one thing as I'm sitting down, because this is about how many people are here, let's get the financial engineers and all these guys out and get sensible people in controlling things. I think that's exactly the wrong prescription. I think the problem is that the senior managements of most of the firms, that the boards of directors of most of these firms, and most of the regulators and overseers don't understand any of these complexities of the derivatives markets or anything else. They're the ones who are making the ultimate decisions. Now, I'm not saying there are people down the line that don't. I actually think it has to go the other way, that we have to expect that overseers and senior management do have to understand that. They don't have to be financial engineers, but they do need to understand what they're overseeing. And the idea that we would dumb things down for the economy and for the financial system because the people sitting there don't understand it doesn't seem to me to be the solution. The solution is, if they can't get educated, replace them with people who are. Thank you very much.